reason for the loss in the quarter at the net basis was the cost of the recent refinancing, where we refinanced our very expensive 2014 bonds with much lower cost bonds, which also extended our maturities. But that led to once-off charges of $89 million, of which about half was cash costs and the other non-cash costs. And we took that full write-off or hit in the third quarter. So it's a once-off charge, not something we're concerned about. And the main reason for that is that going forward now, our interest charges on the income statement will be lower by about $45 million per annum, and the cash cost about $30 million, in addition to the benefit of having a much better maturity profile for our debt going forward.
Let's look at the 9-month period. For the 9 months through to the end of June, you had sales of $4.7 billion, and that of course is down by around 14% across the group. Tell us where sales and volumes are dropping off.
I think the first thing we've got to concentrate on is sales itself, the sales number. And the major reason for the drop in the sales number is only a currency effect, and the translation of our South African rand-based sales and the European euro-based sales into dollars, where the dollar is significantly stronger. And that was the major reason. In terms of volumes, our chemical cellulose volumes are up, and that business is performing very well despite tough world economic conditions. In our North American business, volumes for paper and pulp held quite well, but the prices were under pressure. So there we had a price issue, particularly for pulp in our North American business. In Europe, volumes were down between 5 and 7%, depending on what grade of paper that was. Not totally unexpectedly, we expected a drop in volumes in Europe of about 5%. Year on year.
Many are concerned around how actively you need to manage your European business specifically right now. Can you enlighten us as to what your view is on the problems and how Sappi needs to respond to this?
It's a very important part of our business. As we've said before, we want to grow our business in faster growing markets, and that's chemical cellulose mainly, and we need to fix our paper businesses, and the biggest one is Europe. I think we've done a lot so far, and we're seeing the results of that. We took $100 million of cost year on year out of that business. We took a lot of capacity out of the business, and our operating rates are actually higher than that of the industry as a result of the actions we've taken. Are we there? No, we're not there yet, and that you can see in our numbers as well. I don't think the third quarter was a particularly good example of how we're doing there. On a year-to-date basis, the business is performing a lot better than it did a year ago. And going forward, we expect to further improve. We're aiming to get to operating margins in our European business closer to 10%. We achieved over 5% in the last quarter. What are we going to do going forward? We're certainly going to take out more cost. We're going to manage capacity very aggressively, and where possible, we will also participate in industry consolidation deals. So yeah, more needs to be done.
You talked about industry consolidation, selling non-core assets, reducing capacity. During the quarter, you sold Boëttger for $57 million. You sold Adamas for around $6 million. Tell us how many assets you've identified, or what portion of your assets you've identified that could be up for sale now.
There are more facilities that we do have and assets which we're not using effectively at the moment, and we'll continue to look at selling them, and even smaller parts of businesses. I think in the next year we can look at generating between another $50 and $100 million of additional cash through the sale of non-core assets.
In Europe?
No, I'm talking globally.
Globally?
Yes.
In terms of the cellulose business, all of your profits, in fact, in quarter 3 in Southern Africa came from cellulose.
It did.
It's doing very well. Tell us about the markets that you're selling to and the type of products that that cellulose is being used for predominantly.
It's a great business for us, and yes, it did produce a huge amount, more than all of our South African profits for the last quarter, and up to 50% of the group's profit from time to time. We're the world leader in this business. We've got one facility only at this point in time that manufactures that, and that's at Nkomazi in Natal, KwaZulu-Natal. We produce nearly 800,000 tons of chemical cellulose per annum at that facility, a low-cost, world-class facility, and we export all of what we produce worldwide, mainly to China, India, Europe, and the United States. The majority of what we make in chemical cellulose is used in the textile industry, and it's a product that's used alongside and in competition to cotton in a fast-growing market, and it's in a market where cotton finds it difficult to grow because of water usage, pesticides usage, and it competes for land with food where our trees don't. We've had EBITDA margins on average of 30% plus in this business, and therefore the decision to aggressively grow the business and to ensure that we remain the lowest cost and biggest producer, world leader in chemical cellulose. We've announced the 2 expansion projects, one at Ngadwana and Mpumalanga, where we're spending about over 2.3 billion rand, and an expansion there of about 230,000 tons per annum. And the second expansion, which is on the go as well, is in our Cloquet mill in Minnesota in the US. Both these projects should start producing in the third financial quarter 2013.
When they do, what will that do for your business in terms of revenue and then bottom line?
A significant improvement. We're adding, between these 2 projects, about 500,000 tons of capacity in a business that's traditionally produced 30% EBITDA margins. So taking our capacity from 800,000 tons to 1.3 million tons is a very significant increase in turnover, but also a significant increase in margin.
Lastly, your view of the world right now. I mean, we're getting a lot of views as to where the Chinese economy is, where Europe is, and of course a slowing US economy. From Sappi's perspective, what are you seeing?
We think, from a Sappi perspective, that we've seen the worst. We think that things have leveled out. We expect market conditions to be fairly tough going forward. Looking ahead for the next 3 months to a year, we do not see a major cliff and a further downturn of any significance, but neither do we see a big uptick and a massive improvement in demand and just general economic conditions. So for the next year, we think it'll be tough, improving slightly, and after that we hope that it will improve more.